Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Monday, the 27th of November. I'm Daniel Lam, your host for the podcast. In our podcast last Wednesday, we talked about how oil prices may remain under pressure due to falling global demand. Now, you may ask, how do we monitor this trend? Well, we can certainly read the technical chart, or we can observe the shifts in demand and supply. But there is actually another way that links oil with gold. So one of the main themes in the first half of next year is the fine balancing act between soft and hard landing expectations. A key signal of how this may play out will be commodities and the divergence between various commodity markets. So for example, we would expect both gold and oil to perform well if there were to be a soft landing scenario where the US avoids recession and China stabilizes, and then rate hike fears move off the table, but global demand remains sufficient. Now, in a world of deteriorating growth, however, we would expect gold and oil performance to diverge, with correlation turning negative. And if the Fed were to cut rates in the first half of next year in response to deteriorating growth, we would expect upside for gold and pressure on oil prices. The peaking interest rate and the currently weak trend in the DXY are key sources of tailwind supporting gold prices. Now, gold held key support at around $1,930 per ounce and rebounded again. It may rise further on a more sustained manner when we get more confirmation of potential rate cuts. Now, the physical market has held up surprisingly well in the face of higher or close to record high prices in some regions. We continue to believe that gold provides diversification benefit for investors. It can be an effective hedge if there were to be any geopolitical risk. For example, the World Gold Council Gold Return Attribution Model shows that of the 7.1% return in October, 6.1% was unexplained by macro factors, underscoring the strength of the geopolitical risk premium. Most of the flows in October were driven by a 337-ton increase in tactical positioning in light of the conflict between Israel and Hamas, following a drop in positioning of 318 tons over the preceding 2 months in August and September. That is all from me for today. As always, if you enjoyed this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.